I'm going to make this a
I love that
ringtone.
part. All right. Welcome back to the I Love Annuities podcast. I'm Jeremiah Conger.
And I am Zachary Van Ness. And together we are the Annuity Dudes.
Today, we're diving deep into a hot topic that's especially timely: upgrading or replacing older annuities.
Do you remember having those ringtones, like a song as a ringtone?
Yeah, of course I do, man.
Did you have a go-to?
No, I don't think so. I think at one point I had MC Hammer.
Naturally. Who wouldn't?
Can't touch.
What did I have? I had the Monday Night Football one. That was a good one for my alarm. So that thing would wake me
What
up.
the? Oh, no, that's the NBA.
No, it was now I can't think of it. Anyways, but it was loud enough to just startle you awake.
Yeah.
All right.
The ESPN.
The ESPN one, yeah. Oh yeah. All right, I digress. What are we here to talk about today? Not ringtones.
Yeah, we're talking to the opportunity right now to upgrade or replace older annuities.
Yeah, and really, when we look at this, we're seeing a lot of traction here and a lot of communication that we're having with existing clients and folks that we've never talked to before, and just wanting to better understand if there's a better opportunity out there for them for any annuity agreements that they've purchased, whether it's 3 years ago, 5 years ago, or 10 years ago, just to compare the market where we are today to where we were, 5 years ago.
Yeah, that's right. And the big question today is your annuity still the best that it can be? Or could it use a little upgrade? And could there be some additional benefits at exploring some of the newer product innovations that have happened within the several last years?
Yeah, and what we're finding, when it comes to the interest rates today, they are dramatically higher than what they were a few years ago. If we look at back in 2021, I know in Florida here, we saw rates that were dropping down to high twos, low threes on mortgage rates, for example. This means that current annuity products, compared to 5 years ago, are now offering a more significant or significantly better interest rates and better income rates as well. Higher growth potential, improved features, even we're seeing that change over time. So a lot of changes across the board.
Yeah, and it's really about just comparing these older contracts. The older contracts that we've seen as of late that have come through our organization, looking at replacement opportunities, those would typically have an income payout in the 4 to 5% range. And we're seeing today some of the higher income rider rates, depending on age, of course, but they're in as high as 7.5 to 8%. So there's significant opportunity in replacing these older contracts that can really give you a nice bump in your lifetime income payout.
Yeah, so really that 2 to 3% change. Well, what does that mean when it comes to your paycheck that you're getting every month? Well, ultimately, that could be the difference between what you're getting now and an extra $10,000 to $15,000 a year.
Yeah, I mean, on a $500,000 annuity, that's a no-brainer, right? That extra
Right.
increase is going to be worth your while to get that upgrade and benefit by having that higher lifetime income. So, when it comes to income-focused annuities, especially those that were purchased maybe 5 years ago, it's a fact that they may not deliver the guaranteed income that today's annuities can provide. So switching could mean more secure income every month, which means ultimately more peace of mind, which is why mainly people purchase these types of annuities.
Yeah, and when we get into these annuities, we also consider the different types that are there. So we look at lifetime income. Is there a way to improve that when we look at that comparison? We also look at the growth, right? We can also use annuities for safe market growth. And when we're considering that, we talk about that growth focused index annuity. older index annuities often do have lower caps and participation rates than what's out today. Um, Jeremiah, can you explain what that means for an annuity owner?
Yeah. So if you have a growth focused annuity, typically a fixed indexed annuity, you could even have an older variable annuity. And what's normal inside of those contracts in regards to how that contract earns interest is based on the performance of an underlying market linked index and the rates, the crediting rates of how that index performs. So, in other words, if you're in, let's say, an S&P 500 strategy that has a cap, back then, if you bought an annuity within the last 3 to 5 or more years, the caps normally associated with contracts in that time frame would be significantly lower. So, an example would be a contract having, let's say, a 5% cap. So, whatever the S&P does year to year, you can only earn up to 5%. But today, we're seeing cap rates significantly higher and actually double that amount. So, if you're in an older contract that was more designed for growth, there's no doubt that you can get better deals today, given the fact that we're in a higher interest rate environment, which then correlates to higher annuity rates inside of these vehicles.
Yeah, I mean, if we talk about real life scenarios that we've seen, I know I'm working on one right now. Just as a baseline example, um, the S&P on her policy that she had purchased from 2021, S&P cap rate for a 1 year is 3.5%, and we're seeing that even higher now, right? So at no additional cost, maybe that same index is somewhere around 7 to 8, even higher, 7 to 8% or more. Um, so really what we're talking about is really comparing these and looking at upgrading to more or less turbocharge your annuity's growth potential without that exposure to market risk.
You also could be in a situation where you bought an annuity several years ago and the darn thing just hasn't performed. Maybe you were sold on, a specific index that was supposed to be the best thing since sliced bread. Maybe you were sold on a bonus, and that's why you bought the product initially. But either way, you may be in a situation where you've gone a few years into this contract and you haven't experienced any growth whatsoever. And there are ways to improve that situation. And there are ways that we can get you into better contracts with better index crediting strategies, including higher participation rates, higher caps that can improve your overall situation to help you meet those financial objectives that you set out to meet. One of the things that we look at right now is some analysis that was conducted by Moody's, and the performance of these fixed indexed annuities today is light years ahead of annuities that were sold back in 2013, 2017, and even 2020, and just a few years ago. The innovation in this space with the crediting strategies and the higher participation and or caps has definitely been a game changer, and these products have only gotten better. So it's like, if you kind of use the analogy of like, I always use cars, right? So if you look at a Ford F-150, I'm a truck guy, so like I like Fords. I like them all, but Fords right now is what comes to mind. So if you look at the F-150 line, if you compare a 2015 model to a 2025 model, the 2025 model is like from an entire new generation. It's like from the future when you compare just 10 years ago with that truck included in terms of features and benefits. So with annuities, it's no different. You're going to get significantly higher rates. You're going to get significantly better index crediting options. And you're going to get a lot of other features and benefits that may have not even been a thought in annuities 5 or 10 years ago. So we'll be covering some of those additional benefits here later in the episode.
Yeah, that's a great point. And we're across the board, we're finding that those features oftentimes add value at no cost, right? So we've talked about some things, whether that's long-term care. We've talked about the ability to withdraw some funds in the life, event of a crazy life event that comes up. Not in every case, but that's also part of the process that we're taking, and being methodical, taking our time and making sure that we're finding that right fit for somebody, and finding out if exchanging that older policy is the right fit for them.
Yeah, so some of the studies that we've looked at recently, there was a analysis conducted by Moody's, which I mentioned a moment ago, but the current products today on the today's marketplace offer generally 20 to 40% higher participation rates, which translates to higher growth opportunity compared to older annuities. There's also those new index strategies, some of them better than others, but that's where you need to really look at them and see which ones are actually performing and which ones aren't, so you can do a good comparative analysis. There's even AI driven index strategies now that are just alluding to better volatility control, which therefore smooths out the return potential to just offer smarter growth opportunity in the future.
Yeah. Yeah. And some of those options, like those, the AI driven or the volatility controlled, you know, I speak in sports terms maybe too frequently, but when we look at the index performance, sometimes I liken that to your single hitter, your leadoff batter that's going to hit singles. Maybe it's not going to be the huge volatility that we might find in the S&P, but it will be more consistent in that overall return.
Yeah, and one of the things that we're passionate about is explaining that not all index strategies are equal. I still believe that you need to work with experts that can help you decipher the good index strategies versus the bad ones. And so in previous episodes, we've talked about um, the benefits of working with someone that has the tools to do that comparative analysis and kind of put these things side by side so that you can make a good decision. Actually, working with a client recently, this week actually, and I think we've had 4 meetings now. And initially, he came to us because he was pitched this annuity in particular that um, kind of speaks to, like, all of their marketing and their brochure speaks to the opportunity for increasing income out into the future. And it's all performance driven by the indexes. So, in other words, if the indexes perform good and outperform the minimum income guarantee, then that product will step up the income benefits so that the person has increasing income potential. Uh, so it can kind of act as like an inflation hedge. And he's loves this idea, but it's one that is commonly pitched out in the marketplace. It's one that we are very fond of in terms of being able to kind of deplore the marketing fluff and say, look, like, this is what it says, but the reality or the probability of that ever actually happening is slim to none. And we do that by the index analysis and the comparisons. And so after exposing these index strategies and showing this gentleman that they don't actually perform the way that they illustrate in those back tests, it really was eye opening to him. And he kind of felt duped by the advisor that was showing him this product. And I don't blame him. I would feel the same way. But that's where it comes down to working with an expert that truly has your best interest at heart. And we're going to back up what we claim with factual data that you can understand so that you can ultimately avoid making a grave mistake. And if you do decide to purchase an annuity, the one that you're buying, wholeheartedly that it was the right one for your specific circumstance because you got the education and the comparative analysis to make that confident decision to buy.
Yeah, and I think the big way that we provide that is the transparency, whether that's just speaking frankly to somebody, sharing our screen, sharing the data that we have in front of us that help us make the educated decisions that we make on a daily basis, but allows somebody to have that in their hands so they can ask those questions without feeling like there's a pressure to make a decision. It's, hey, let's find out if this is the right fit. And if we're looking at replacing or exchanging an existing policy with another one, oftentimes what we're finding is that there is some type of surrender penalty that comes with that, or surrender charge. And a lot of times, folks that we speak with are just We've uncovered that surrender charge and how that may affect them, and they feel like they're in a little bit of a hole of, oh, I'm stuck, right? And what we found is that, really now when we're comparing that older annuity, oftentimes that surrender penalty, uh, we've got a way that we can offset that with a bonus. And some of these newer policies provide that feature.
Yeah, it actually goes back to our days, Zach, on how we actually became friends. We were working in the cell phone industry. We started at Nextel together, and beep beep beep. You remember the chirp? um, those were good times. But I relate this actual segment in our podcast episode here to, like, back then, the wireless companies were notorious for cancellation fees. Like,
Oh
if you
yeah.
did not, fulfill your 2-year agreement, then there was a penalty. And in annuities, it's no different. There are these surrender penalties that, if you exit early, there's going to be a penalty assessed on that cancellation. But like the wireless industry, one that comes to mind is like T-Mobile. They tout that, hey, we'll pay your surrender fees if you switch to us, no matter what. We'll pay your cancellation fees. Annuity companies are doing the same thing. So right now, while we're not normally fans of bonus products, there is a use case here for bonus products, and that is to help people get out of these older, maybe underperforming contracts so they can get into something new that's better and gives them more opportunity and potential and maybe even more features and benefits, without having to sacrifice their principal. So they're able to offset those surrender penalties. And that's where we really see the value in appropriately using a bonus product to help with that. So you may be in a situation where you're newly into a contract, maybe less than 5 years in, and there's some pretty lofty penalties there. But right now, I mean, one that comes to mind, there's a product that's really good, really good index strategies, really good rates on the index strategies, and they're offering a 14% bonus on your premium day one if you buy that annuity. So most annuity surrender penalties start out at 10% and then decline about 1% a year every year that you fulfill the contract. So one client that we just worked with had a 5% surrender penalty. And after factoring that 14% bonus, they're netting 9%. And this is actually going back into a contract that also, for this particular client, the one that they're replacing, it didn't perform. So the 4 or 5 years they were in it, they literally had like less than 1% return. And it's because they kind of bought this product under the hype and guise of, you know, this incredible index strategy, but the index strategy was not proven. And they learned the hard way that, it wasn't going to do anything. And so, long story short, now this person was able to upgrade their annuity, get in a better situation, into a better product that helps them meet their long-term objectives. And on top of that, by making the switch, they're netting 9%. So if you look back, it's like they averaged at least a couple percentage points a year. So at least it hedged or paced inflation for the most part. Maybe not exactly 1 to 1, but it kept up a little bit versus nothing at all.
Right, right. And it's a utility that we need to review closely, right? So it's just finding out there's different bonuses all over the place. One might be 10%, one might be 6%, another might be 20%. But it's just finding out within that annuity where the value is, where are we really getting the value for your unique situation? It's not going to be the same answer across the board.
And that's a great point too. And I think it's a good call out there, Zach, that the bonus isn't everything. You shouldn't be making the decision on who has the highest bonus and how much you're going to net after making the switch. You still have to consider the long-term impact on that
Mhm.
decision. So, there's a product out there now touting 21% bonus. I looked at it and I don't think it's better in terms of index growth potential than the 14% bonus product. I think the 14% bonus is a better deal because the index return potential is higher long term. You have to make sure that you go through our multi-point inspection to still uncover all of the nuances of the product and all of the important evaluation points that should be compared and considered, so that you're not just getting into another bad situation. You might think that, oh, I'm going to get this big bonus. But then if you go into the future again and have no returns from the index strategies, the bonus is then being diminished. So you want to get into a product that is A, going to help you offset those surrender penalties that you may have, but B, that it's still giving you the best potential to meet your financial objectives. And that would come from having A, at least two, but preferably three or more good proven index crediting strategies. And then B, that it's from a credible company that has proven track record to deliver on their renewal rates on those said index crediting strategies. Those are important evaluation points.
Yeah, and part of again, going back to our process is just setting those right expectations. What are your expectations of this annuity? What can we really lean into? And part of that, we use our qualifiers within Annuity Association that we have our own checkpoints on. These carriers do the same, right? So from their end of it, ultimately, they're out there to look out for your best interest too, to make sure that if you are exchanging your existing policy for another, is it really in your best interest? So there's a couple layers that we're taking in our process, as well as the carrier. Um, and Jeremiah, from your end of it, why do you see this as important from that carrier's end of it?
Well, the first thing to note there is that um, annuity transactions are very heavily regulated by the government. And that's a good thing. I'm not normally big on government oversight, but when it comes to these types of things, I do think it's essential to keeping carriers accountable, keeping advisors and agents accountable, and helping consumers make good decisions. So I do appreciate that government regulation there. And because of that regulation, some carriers have a very stringent replacement policy. In other words, they have these requirements that they'll only accept a replacement if these requirements are met. So not every carrier is as lenient on accepting replacements. Some actually have a clause where they don't accept replacements at all. And what you find is that it varies carrier to carrier on what exactly those grading criterias are on whether or not they will accept a replacement contract. So that's where it's really key. Again, making sure that you're working with an expert that can help guide you in the right direction so that the time that you're spending is not only getting, finding and identifying a better product for you, but that whatever that product may be, that the carrier that represents that and offers that product, that they're going to accept your case. Because I know that these replacement contracts can sometimes be very complex. You have to have a really good case and evidence to back of and backing that evidence up of how it is in the consumer's best interest. And if you're not dotting your I's and crossing your T's, or maybe you're not even looking at the carrier guidelines specifically, you're going to waste someone's time, and it can be a lot of time that goes into these replacements. We're talking 4 to 6 weeks at least to get them through the suitability underwriting and all of those. So the worst case scenario is you get a automatic decline because it wasn't even a carrier that would have accepted it in the first place. So work with an expert, make sure that they have a guide that they're following. It's something that we're passionate about, and we actually have a proprietary process that uses basically a data aggregator of all the carrier guidelines, and we make sure all those boxes are checked before an application is ever submitted.
Yeah, yeah, and it's so important because at the end of the day, you're taking your time out to make the right decision for yourself, and the advisor needs to be looking out for not only your best interest but your time commitment as well. Um, I can only imagine that feeling of submitting an application with a certain expectation that advisor A told me this was going to happen and it'll get approved, and come to find out you waited a couple weeks to hear from the insurance company and found out that you won't be approved.
Yeah, and that's one thing. I mean, I've had these situations happen where someone came to us and they're like, "Hey, we worked with somebody, and they weren't able to get us, helped out. They weren't able to help us improve our situation. When I ask them what happened, and they tell me, well, we submitted an application with ABC carrier and we got declined. My next question is, well, why did they even submit that with that carrier if you didn't meet their guidelines? And a lot of times they scratch their head and they're like, what guidelines?
Mhm.
And it's a rookie mistake, honestly. Like, any expert in annuities should know these guidelines like the back of their hand for the most part, and know that the product that they're positioning to that client should have a high probability or likelihood to be approved. And if they're not, they're doing you a disservice.
Yeah. Yeah. And I think that's also falling back on working with an independent agent, right? So somebody who has access to the full field of annuities and having access to understand what comes with that and navigate that suitability process smoothly so that you don't run into those unnecessary hurdles. And an expert will help you and clearly articulate why that exchange to a new annuity is a better solution, and if so.
Yeah, for sure. So that leads us into our next segment. And there's been a lot of innovation in the indexed annuity space in particular within the last 5 to 10 years, more so in the last 5 years. And one of those features that is now starting to show up as part of a value added benefit in a decent amount of the offerings on the market is all around the enhanced income benefit for long term care. Most annuities from a decade ago didn't even offer this type of benefit whatsoever, but today about 57% of the income annuities offered today include an enhanced income benefit for long-term care. Zach, why don't you tell us what that enhanced income benefit for long-term care is exactly?
Yeah. So when we're looking at that enhanced benefit for the long term care, most, like you said, most of them didn't offer this feature about a decade ago. But really, what it's doing is it's allowing the opportunity for the income to double for a set period of time. In most cases, that income has the ability to double based on the account value and what's available there within the account value, and can double for up to 5 years or 60 months. With that care benefit that's now added, again, typically at no additional cost, now you're able to help yourself if you're unable to complete 2 out of 6 activities of daily living, whether that's feeding yourself, bathing yourself. Um, this tool is implemented most commonly just by filling out a form saying, hey, I check these boxes. Here's my doctor's evidence of that. And from there, you're able to use that feature.
Yeah, and it's a really important feature and benefit, especially for people that don't have any traditional long-term care coverage. I believe the statistic today is like 75% of retirees today don't have a formal long-term care plan. So, in other words, they didn't secure traditional long-term care coverage when they were a bit younger and have been paying into this plan for so long to be able to cover those incurred costs. So, if you're looking for a way to add some long-term care benefits to your overall plan, an annuity like this is a way to do that. But I will tell you, while there is a fair amount of income annuities offering this long term care enhancement, you do have to be aware of the fine print. There are some products out there that actually, majority of the products offering this feature have a stipulation in the contract where it states that in order for this enhanced income benefit to be available, there needs to be account value remaining and enough to cover those long-term care payouts, which are usually a doubled amount of whatever the guaranteed income amount is. So, in other words, if your guaranteed income amount from the annuity was, say, $30,000 a year, if you qualify for the long-term care enhancement, it will double that 30,000 to 60,000 and pay that for up to 5 years. But in the contract of the majority of these products, it states if there isn't an account value remaining, that and enough to cover the long-term care doubler, then that benefit will be null and void. So there are, though, this has been kind of a pain point that we've been lobbying for to be addressed, and that is this is a great feature and benefit, but if the product isn't built and designed to be able to sustain the account value long term when someone would go on claim, then the benefit is smoke and mirrors, really. It's just all marketing fluff. And so that actual pain point has been addressed by a few products. There's not many, but there are a few that are on the market today that have addressed that. And in the contract, it states that regardless of the contract value or account value, even if it's depleted to zero, that enhanced income benefit doubler for long-term care is still available. And that's something that you need to be aware of. And you need to make sure whoever may be positioning this annuity product and kind of building up value around this enhanced income benefit for long-term care, that it needs to be one of the products that has likelihood to either A, sustain the account value. And the way it would do that is by the actual growth potential of the index crediting strategies. It needs to have proven performance and strong enough crediting rates to be able to do that. And then B, that if it doesn't have that, then it has a contractual element that states even if the account value depletes to zero, that the enhanced income benefit is still available.
Yeah, and to your point, roughly, I think it's more than half, over 50% of these contracts have that long-term care feature built into it. So again, understanding the utility of how can we use it, in what spaces can we use it in, and what are the odds of me being able to use this feature are beyond important to know. And if this is a mainstay in your consideration of why this annuity might be a fit for you, then we got to dive deeper and find out if there's a better solution there.
For sure. And that'll lead us into our feature comparison snapshot. So, we've covered a lot here on why someone may be inclined to look at upgrading their older annuity. And we put together a brief chart that'll highlight some of those benefits just to kind of do a quick recap here. So, Zach, why don't you, if you can see my screen, why don't you cover some of those features and benefits there?
Yeah. So we've talked about using a fixed index annuity for the purpose of lifetime income. And what we've found is frequently in these contracts that maybe in the range of 10 or 5 to 10 years older, um, oftentimes we can get better payout rate. So the amount that you're receiving as an income distribution for your lifetime income, oftentimes there's a 2 to 3% difference. And we're seeing that right here if we compare a product from 10 years ago to today. So it's just understanding and comparing if there's going to be a value that you get from a newer product today. Um, Income bonuses, we talked about bonuses before, like you mentioned. Is that income bonus higher today than what it was then? And how does that affect that payout that you're getting? Another thing across the board that we've noticed is that the fee oftentimes is less. Not in every case, but when we compare that, again, part of the value that we're bringing is that transparency so that we can compare and find out if there's a better solution for you. Furthermore, the index selection is probably the most, in my opinion, the most glaring component when we're comparing these side by side. Those index options are oftentimes much better in today's current environment than what we've seen in the past. I've seen it firsthand myself. I know you have as well, Jeremiah. So when we really break those down, it's just optimization. Can we optimize what you've already got and improve it at no additional cost? And oftentimes we've found that. The participation rates go hand in hand with the index selection, and that oftentimes a higher participation rate joins that. One feature we've talked about, we just wrapped up on, was that long-term care benefit. We see that in over 50% of these income annuities today. And also we want to compare that carrier rating. We've got more information that we can dive into today than what we had 10 years ago in finding out if that carrier is the right fit for our client.
Yeah, those are all good points. And the other one that may have been left off there was the premium bonus to help offset those surrender penalties that may be assessed on an early surrender. And then another thing that we haven't really delved into too much here, but we've touched on a couple times is like, how is this opportunity and why is this opportunity available? And it's simply because annuity products are correlated to the interest rate environment that we're in. So today, in 2025, we're in a peak cycle of the interest rate environment, where many people are thinking we're at the top and that those interest rates may start to come down. But just a handful of years ago, we were in a historically low interest rate environment. So that's why those income rates were lower. That's why those fixed rate annuities were lower. That's why those growth indexed annuities were the participations and the caps were lower. It's because of that interest rate environment that you were in back then when you purchased it. So now, being in a higher interest rate environment, we have better product offers, and that's why this opportunity exists. And I will tell you, um, with the interest rate environment potentially being on the decline here in the near future, none of us really know for sure, but at some point they are going to start coming down. But there's never been a better time to consider upgrading or replacing an older annuity, simply because we're at the peak of an interest rate environment with the likelihood that that's going to go down. So the rates that you're seeing on today's annuity marketplace are the highest they're going to be in probably a few years. So if you're on the fence and maybe just thinking about this, the best thing to do would just to be, obviously, just do some comparisons, see what the benefits are, see if it makes sense to upgrade, and you might find that it is. And if it is, now's the time to pull the trigger. Definitely you should take your time to the point where you're comfortable, but just know that interest rates may be on the decline. So if that happens, the rates you see today will no longer be available. But definitely do not rush this type of decision.
Yeah, great point where we're treading lightly here and talking about this topic because it is a little sensitive in making a move like this. And part of what we're trying to really instill is that by working with the right agent who can bring all this information to you up front, hopefully it's us, maybe not, then at least you've got the knowledge and expertise to know, hey, at least I did my research. I found out if exchanging my existing policy is the right thing for me today. And then you can rest that much easier knowing that you've done your homework and you've done your research on your own.
Exactly right. And what we have found is not every annuity should be replaced, but there is a significant chance that a majority of older annuities could benefit from an upgrade, and consumers or owners of those older policies in particular could benefit. And that's where you really want to make sure that you're comparing all of these factors into um, a good sound decision making process. So some of the things that again, want to account for before you make the leap are the surrender charges. What's the impact of changing and replacing an older annuity, and are there opportunities to get into a newer product that will help you offset those surrender charges? Other things to consider, right, Zach, would be the loss of income guarantees. So sometimes you may be in a situation where the income you're getting, while albeit not be the highest potentially income you could have today, but you may not have enough account value left to transfer into the new annuity to give you more income. There would be a disadvantage to sacrificing an income that is more than you could get if you moved, even though there might be other benefits that are different in the new policy. If your primary objective was income, we want to make sure that you can at least get an upgrade on your income. That would need to be a qualifier in order to make sense of it. What are some other things that someone would want to consider there, Zach?
Yeah, again, we've talked about the replacement of the income. If we're looking at different annuity types, maybe a fixed index annuity for the purpose of accumulation, we want to find out what, if anything, somebody might be lacking in that existing policy. Again, we've talked about certain features, whether that's maybe a care feature or maybe even a waiver. Maybe there's a waiver in there where you can access funds should you have a life event come up where you're confined to a nursing home or a care facility. Maybe that waiver is not built into your existing policy. Maybe there's a solution out there that will allow you that access if that's important to you. These are some of the intangibles that don't come to the forefront of why a replacement would be necessary, but oftentimes they're a big value add. When we really key in on the value behind what's brought to the forefront most of all is, yeah, higher participation rates, higher cap rates, and just comparing, is this the best solution for somebody?
Yeah, and that's where it just comes down again, working with an expert, someone that can, help you analyze all of these factors, help you do a very thorough comparative analysis, and ultimately showcase why upgrading that older annuity is truly in your best interest, and they need to back it up with supporting factual data. So that's something that we pride ourselves in, is the transparency and the analysis that's needed to do these complex upgrades and replacements. It's something that we do every day, and we're honored and blessed to have that opportunity where people are confiding and trusting in us in this important process and this important decision. If you would like to have a free upgrade analysis done on your older annuity, we would love the opportunity to earn your trust and earn your business. And in order to do that, to get started, very simple. There's two ways. In the show notes or description of this video, there will be a unique link to just go ahead and schedule your annuity discovery meeting with one of our subject matter experts. Or if you're not just quite ready yet to speak to somebody on a Zoom meeting, we can just get started with showing you a free annuity report that's tailored to your specific situation, to show you the potential benefits out there and why you may consider upgrading, and what's out there if you do, what's available to you. So to do that, there will be another link to request your free annuity report. But either way, our mission here is to help people make better annuity buying decisions. We do that through education, trust, and transparency. So, with that being said, we appreciate everybody tuning in to this I Love Annuities podcast episode. If you've gotten some value out of this, please give us a thumbs up, a like, and share. We would greatly appreciate that from the bottom of our hearts. Is there anything else that you'd like to close out with, Zach?
No, I just want to add, from what we had talked about last week in comparing pension income to an annuity, here we are comparing an old annuity to a new one. Ultimately, we're just trying to make sure we're taking the best practice and for everybody, right? So it's just comparing what's out there on the market, seeing what the right fit is for you. So we'd love to talk to you about this more. And really, I think right now, the market environment today is really prime for potentially upgrading that existing annuity and just finding out if there's the right fit and making a change.
Awesome. I love that word prime. That's key, man. So again, thank you for everybody tuning in. We appreciate your viewership. We appreciate the time that you spend with us. Again, like it, give us a thumbs up and share. We would appreciate that as well. This is Zachary Van Ness and Jeremiah Conjures signing out as the
Annuity Dudes. We'll see you
Have a
next
great day,
time.
everybody. Take care of one another.